Good morning. It is Monday, April 6, 2026. This is your deep dive daily briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 12 hours. We begin our broadcast on the world stage, where the strategic landscape of the Middle East has entered a critical new phase following the conclusion of the weekend. Overnight, reports from regional monitoring groups and official military channels confirm that the United States and Israel have expanded their kinetic operations across Iran and southern Lebanon. This follows the expiration of a prior 5-day reprieve and a failure of diplomatic efforts in Geneva to secure a maritime security corridor. The current air campaign has reportedly shifted focus toward degrading Iran's decentralized electrical grid and specialized manufacturing zones used for long-range drone production. This escalation comes as the United Nations warns of a deepening humanitarian crisis, with the total number of internally displaced persons across the Levant now exceeding 1.3 million. Despite calls from the G7 for an immediate cessation of strikes on civilian infrastructure, the rhetoric from Tehran remains focused on a long-term war of attrition, leaving regional stability in its most fragile state since the conflict began on February 28.
Transitioning from the front lines of conflict to the broader global economy, the narrative is being driven by the visceral reaction of energy markets to the prospect of a prolonged closure of the Strait of Hormuz. Crude oil prices have surged in early Monday trading, with Brent crude frequently breaching the $116 per barrel mark. This supply shock is being managed by a special coordination group formed by the International Monetary Fund and the International Energy Agency to mitigate what they describe as a historic energy shortage. While the IMF has maintained a projected global growth rate of 3.3% for 2026, economists warn that the persistent disruption of a waterway that handles 20% of the world petroleum flow is creating a structural drag on industrial productivity. Manufacturers in Europe and East Asia are now facing a period of constrained stability, where the high cost of energy is being compounded by new trade surcharges and the forced front-loading of inventories to prevent production halts.
In the realm of finance, all eyes are on the credit markets as they process the dual pressures of geopolitical risk and a sudden contraction in private lending. Overnight, the private credit sector faced a significant stress test as several major funds moved to limit withdrawals following a surge in redemption requests from institutional investors. This move has raised concerns on Wall Street regarding the liquidity of the non-bank lending structures that have heavily financed the recent artificial intelligence boom. Simultaneously, the 10-year United States Treasury yield remains elevated at 4.39%, reflecting investor anxiety over sticky inflation and the long-term cost of sustained regional instability. As the market processes the latest labor data, the financial sector is also weighing the impact of potential record-breaking IPOs in the aerospace and defense sectors, even as capital continues to rotate toward defensive assets amidst the mounting uncertainty.
Turning our attention to the technology sector, the focus has shifted toward the high-stakes paradox of massive valuation expansion and growing infrastructure risks. Reports released this morning highlight a growing concern that the AI revolution is facing a physical power ceiling that could stifle growth in the coming years. While companies like NVIDIA and Broadcom continue to see unprecedented demand for AI hardware, the global grid is struggling to accommodate the 92 gigawatts of additional electric power projected to be required by next year. This energy bottleneck is forcing a radical rethink of energy procurement, with hyperscalers now exploring direct investments in modular nuclear reactors to ensure their hardware remains operational. Furthermore, severe shortages in essential components like high-bandwidth memory are beginning to redraw the global supply chain map in favor of localized production hubs in North America and Europe.
Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, which are currently facing a period of intense structural rewiring. The Strait of Hormuz remains in a state of near paralysis, with maritime traffic having plummeted to just a handful of tracked vessels in the last 24 hours. This de facto blockade has forced major ocean carriers to maintain the Cape of Good Hope as their primary route, a detour that adds up to 14 days to voyage times and has triggered a structural shortage of vessel capacity. Logistics analysts warn that, even if the strait were to reopen tomorrow, the ripple effects on port capacity and equipment availability in hubs like Jebel Ali and Salalah will be felt for months. As a result, 72% of trade professionals have now prioritized the adoption of AI-driven adaptive networks, moving away from just-in-time models toward a just-in-case strategy that emphasizes regional inventory buffers. That concludes our global briefing for today. Thank you for joining us.